First rates are in. The Nifty is opening above 17,000.
At the day's low, Nifty has seen cuts of 200 points from the highs.
The market's texture has been still the rally, and in that sense, the market gave you that gap up, and after that, just one-way decline. Familiar script now. Any rally is getting sold into. Today, we had just one, the opening rally, and after that, that was sold into. So from 17,030 thereabout, the Nifty lost almost 200 points.
Hello and welcome to CNBC TV 18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Ekta Batra. Here are our top headlines for this evening. Stock markets declined for the 7th day in a row. The Sensex and the Nifty remain at their lowest level that we've seen in over 2 months. Mid-caps bucked the trend to end in the green. Tata Motors rides optimism following the launch of its attractively priced Tiago electric model, which is seen as a contender for the top slot in the EV segment. Pharmaceutical stocks make a comeback as fears over a big cut in the US generic prices recede and the big drug opportunities open up. Some like Torrent Pharma also get a boost from a positive piece of news. The best is yet to come, says Puneet Chhatwal of Indian Hotels. Expects demand to outpace supply this festive season. Says the company will open more properties abroad but will only manage the assets and not buy them. Godrej Consumer gains after it looks to expand its Africa portfolio, and Tata Chemicals leaps as analysts eye gains from the China +1 and Europe +1 moves. All right, those were the top stories that we're tracking this evening, but here's a lineup of what we have in store for you. It's a packed show today. In Market Opinion, we have Nilesh Shah, MD of Kotak Mahindra AMC. In Big Corporate Voices, we have Puneet Chhatwal, the MD and CEO of Indian Hotels, of the rising demand of the hospitality sector. All right, well, straight to the day's market action. The stock markets declined for the 7th day in a row, with the Sensex and Nifty at their lowest levels that we've seen in over 2 months. Mid-caps bucked the trend to end the day close to 0.5% in the green. However, for the September series, the markets reversed gains of the last one and saw the Nifty fall 4%. Anuj Singhal is here with the details.
Well, the market followed a bit of a script today, which is that there was a gap up because of what the Bank of England had to announce overnight and the knee jerk. But that was a perfect opportunity for the bears to come and sell, because the texture of this market has been firmly sell the rally. And once again, the Bank Nifty led the first decline, and then IT stocks also joined in. Not that the market collapsed, it's just that the rally was sold into. The USD INR remains the big problem for the market. Again, there as well, the rupee started strong, but towards the end weakened quite a bit. IT led the last hour decline, so TCS, Wipro and Tech Mahindra were all down. But the bigger decline came from financials, Kotak, ICICI Bank and Bajaj Finance. In terms of other influential names, you had Larsen & Toubro, Asian Paints and Titan, which were down, while ITC, Dr. Reddy's and Cipla were higher, telling you about the kind of market we are in. Cipla, by the way, today made a new lifetime high. Some of the commodity stocks did well today, though, because of the general global risk on. So Hindalco, Tata Steel and ONGC were higher. Well, this is a market where clearly till the time the market breaks this pattern of all rallies being sold into, it will remain quite weak. Now, whether it ends at 16,800, 16,500, we don't know. But the texture has become extremely weak once again.
Okay, all right, Anuj, thanks very much for that. Well, let's get in some expert opinion for you. Vikas Kumar Jain, investment analyst at CLSA, said that they are struggling to find any margin of safety in the market right now. He added that the differential between the Indian and the US bond yields is now at the lowest that we've seen in the last 13 years. Listen in.
We are struggling to find any margin of safety in the market. So just yesterday, as US bond yields went higher, Indian bond yields hardly reacted. What that has done is the differential between US and Indian bond yield has fallen to the lowest level in the last 13 years of about a little over 3 percentage points or so. If we also look at the differential between bond and equity valuations, so that is something which is already at its higher extreme. We are at levels which has very limited margin of safety, and history is stacked against us to get significant positive returns. So absolute positive returns and large positive returns from here on over the next 12, 15 months or so looks very difficult on the index. If we also look at the differential between bond and equity valuations, so that is something which is already at its higher extreme. So historically, above 2% or so, whenever one has invested money in equities, they've ended up losing money. So we are already at about 2% difference between 10-year bond yield of India and equity earnings yield of India. We were at about 18,000 very recently. What is needed for the market to go up to 19,000 or so, or or 19,500 plus, say by March? I think Indian bond yields have to come down to 7%.
Okay, well, let's get in some more opinion then. Nilesh Shah, Managing Director at Kotak Mahindra Asset Management, said that India will outperform, but the margin of outperformance may taper down. He added that the best investment strategy would be to buy on dips in the Indian market.
Extent of outperformance could narrow down. There is a massive global sandstorm blowing out. We are like an oasis in the desert. But if sandstorm passes through us, some sand will be deposited. So I do believe India is in a better shape vis-a-vis others. We have some challenges like our external position to take care of. But once the sandstorm is over, that India is truly an oasis in the desert. Best thing for investor will be to buy on dips. We are indeed an expensive market vis-a-vis peers on a one-year valuation. And we are indeed a cheap market vis-a-vis peers on a 5-year valuation. So be a long-term investor. Use this correction as an opportunity to build your portfolio, albeit with a longer-term horizon.
Okay, so that's some market opinion, but let's move on. The big cue for tomorrow is the Monetary Policy Committee, which is expected to hike the repo rate for the 4th consecutive time tomorrow. A CNBC TV 18 poll shows majority of the market participants are predicting a 50 basis points hike, and majority are also expecting another rate hike in the month of December. Ritu Singh is here with the details.
Well, the Reserve Bank is expected to raise interest rates for the 4th consecutive time, and there is a wide consensus that the hike could be around 50 basis points. All the respondents to our poll said that there will be a 50 basis point hike from the MPC, arguing that there is no real reason for the RBI to opt for a token smaller move, given what we're seeing from central banks around the world. The Federal Reserve, for instance, just delivered its 3rd straight 75 basis point hike and has shown no signs of slowing down. The majority expects RBI to move swiftly and get the repo rates to 6.25% by December itself, while some are expecting rates to hover around 6%. Now, 4 out of 10 respondents said that peak repo rates could go as high as 6.5% in this cycle, while others pegged it at anywhere between 6 to 6.25%. Inflation does remain high, yes, but it is more manageable at this point. It is expected to have peaked in April, like RBI says, and while there are risks to the outlook, economists do not expect the RBI to revise its current forecast of 7.2%. However, given that inflation has stayed above RBI's tolerance limit of 6% now for 3 consecutive quarters, the MPC will have to write an explanatory letter to the government explaining the reason for its failure to contain inflation. Now, the 13.5% GDP growth we saw in the first quarter, that was below RBI's projection of 16.2%. Now, while a third of the respondents expect this growth forecast to be left unchanged at 7.2%, the majority believes it will be lowered to around 7% in this policy. Now, on the stance, there was no real clear majority. 40% expect that RBI will leave it unchanged at withdrawal of accommodation, but half expect it to be changed to neutral, with some even expecting some tinkering in the wording. Now, the banking system liquidity slipped into deficit for the first time after almost 14 months recently, and there is generally more withdrawal of cash as well from the system during the festive season. So, whether it is an OMO or a VRR or something else, markets do expect RBI to take note of the deficit and address the issue in some fashion. The other thing markets will focus on is comments on the rupee, on whether there will be any measures to attract more dollar inflows, and lastly, any comments at all from the central bank on the global bond index inclusion will also be keenly watched.
Okay, all right, Ritu. Thanks very much for that. So a depreciating rupee and a stubborn inflation is something that the RBI will have to reckon with tomorrow. But on to the second headline now. Tata Motors gained 1% after the launch of its attractively priced Tiago electric model, which some see as a key contender for the top slot in the EV segment. Brokerages are now betting big on this stock after launching the EV variant of its popular hatchback, Tata Tiago. The auto giant already leads the EV segment in the country with models such as the Tata Nexon EV and the Tigor EV. Tata Tiago's EV version is priced starting at 8.49 lakh rupees. This would be the first electric vehicle under Tata Motors to be priced below the 10 lakh rupees segment. Listen in to excerpts from our colleague Parikshit Luthra's conversation with Shailesh Chandra, the MD of the Passenger Vehicle and Electric Mobility at Tata Motors.
I think it's a very compelling proposition for the customers. That's number one. Number two is that if I just go by the trend of what we have seen with our past two cars which got electrified, which is Nexon and Tigor, we have been seeing a penetration of 20-25% in those cars. Given that this is a more compelling proposition as a combination of its features and price, I think the penetration should go higher. On top of that, we are also expanding the number of cities in which we were selling our EVs from 90 to 179 in the next few months, and that should also act as a force multiplier for penetration of Tiago EV and other EVs also that we have in our portfolio. Mass adoption of EVs is possible now. It becomes accessible to a larger customer base, and this customer base will support the demand for future cars which are going to come in the market. So it's going to have a cascading effect, and therefore would accelerate the adoption of EVs even going forward, not even just now.
Okay, well, that's on Tata Motors. But on to the third headline today. Torrent Pharma rallied around 4% despite getting 3 observations for its Indrad facility, while Lupin fell over 2% after a warning letter for its Tarapur unit was issued by the US drug regulator. So I'll start with Torrent Pharma, which was in focus because of the acquisition that they made yesterday worth around 2,000 crores of Curatio Pharma. But Curatio Healthcare rather. But today the stock was in focus because their Indrad facility in fact was inspected by the US drug regulator and was issued around 3 observations. The background on this particular facility is that this plant was inspected in 2019. It was issued an official action indicated status by the US FDA, which then eventually turned into a warning letter in October of 2019. So with the fact that they've been issued only around 3 observations, the street seems to be possibly hopeful that this particular plant could see the light at the end of the tunnel or could get some kind of resolution from the US FDA. But remember, they have 2 other plants which are also under the scanner, and we don't know what these 3 observations are about. So it's a bit uncertain at this point in time. Also, sources have indicated that the H plant, which is also under a warning letter, could probably be inspected by the US FDA soon enough for Torrent. But that's on Torrent Pharma. The other stock that we were tracking today on US FDA concerns was Lupin, because their Tarapur facility in fact was issued a warning letter by the US FDA. Again, this particular plant had already got an official action indicated status, which is basically, it's quite tentative and it means that there could be issues with the plant. It was issued in Jan 2020 and then re-inspected in April 2022, issued observations at that point in time, which has now been escalated to a warning letter. So bad news coming in for Lupin. That stock ended around 2.3% lower. Remember, it's been quite a mixed bag for Lupin when it comes to regulatory issues, because there were certain facilities like the Goa plant as well as their other facility, which is a Somerset facility in New Jersey, were cleared from US FDA concerns. But these plants, a few of their plants continue to remain under the scanner. But let's move on then. The NSE indices will be rejigged, which will come into effect tomorrow. We will see Adani Enterprises, the second stock from the Adani Group, to be included in the Nifty, and Shree Cement will exit the index. Vivek Iyer is here with the details.
Well, that's right. So come tomorrow, a whole host of NSE indices will actually have a new look. None more important than, of course, the Nifty 50. So Adani Ent, like you mentioned, comes in at the expense of Shree Cement. On the back of this particular development, Adani Ent, analysts estimate, will see an inflow of $340 million. And this particular inflow is happening in the session today on the back of the fact that passive indices have to make the changes. Shree Cement, on the other hand, is seeing outflow of close to $100 million. Now, Now, some of the other indices that we are tracking, remember there are changes that have been announced earlier across most of the major indices like the Nifty Next 50, the Mid Cap 100, the Small Cap 100, but some of the top stocks and indices that we have highlighted. So within the Nifty Next 50, have a look at some of these inclusions. Adani Total Gas, a little over $60 million worth of inflow expected. Bharat Electronics, Hindustan Aeronauticals, Bharat Electronics over 60 million, Hindustan Aeronauticals over 30 million. Now, in the range of 25 to 30 million, you also have names like Mphasis and Samvardhana Motherson International. These two are making their inclusion into the Nifty Next 50. On the other hand, some of the exclusions are Jubilant Foodworks, Lupin, Mindtree, Punjab National Bank, all seeing outflows in the range of $15 to $40 million. One key change that is happening in the session today, the CPSE index, while there are no inclusions or exclusions, there's a significant weight change. So Power Grid actually has seen a weight change, and analysts estimate an impact flow of close to $30 million, while Coal India sees a weight reduction. Analysts estimate a $12 to $14 million outflow in the session today.
Okay, all right, Vivek. Thanks very much for that. Time for a break now, but stay tuned. We'll be back in a jiffy with all of the other top stories. Welcome back. Well, on to the fourth headline for this evening. The best is yet to come. That's the word coming in from Puneet Chhatwal of Indian Hotels. He said that he expects demand to outpace supply this festive season. He added that the company will open more properties abroad, but will only manage the assets and not buy them.
The sector has proven its resilience despite COVID. And within the sector, we are the largest hospitality ecosystem. And I think we are very well positioned to take advantage of what I say the best is yet to come. And with the G20 planned as of December, with India getting the leadership, I do think there'll be some kind of incremental demand, which we don't have in normal years. So yes, given our new brandscape or the reimagined brandscape, given our diversified portfolio, I think we are very well positioned. It should be one of the better Q2s that we have witnessed as a hotel industry in the last 5-7 years.
Okay, well, let's get to the fifth story then. Today, specialty chemical stocks like Tata Chemicals and Aarti Industries were in focus on the back of a Morgan Stanley note. Nimesh Shah is here with the highlights of that.
As you rightly pointed out, both are seeing sharp reactions on the back of that Morgan Stanley note. Today morning, they put out a note on specialty chemicals, and in that, they've double upgraded Tata Chemicals to overweight from underweight, and they've sharply raised the target price there to 13.19 from their earlier target price of 8.50. That is on Tata Chemicals. On Aarti Industries, they've double downgraded to underweight now from overweight, and there they've got the target price sharply to 6.85. I'll come to individual reasons as well. They also mentioned about Deepak Fertilizer. They've marginally cut Deepak Fertilizer as well from equal weight to underweight, and there they've got the target price to 17.32. The top pick within the specialty chemical space is SRF. There they have an overweight stance, but they've sharply raised the target price on SRF as well to 35.71 now versus the earlier target price of 27.50 odd levels. Now coming to specific reasons on the downgrades and upgrades. First, on Aarti Industries, the double downgrade is largely on back of reflecting material constraints and slower project ramp up. That's been the key reason for downgrading Aarti Industries. For Deepak Nitrite, the key reason is they're seeing limited visibility on phenol and demand risk in key segments for Deepak Nitrite, and hence a notch downgrade to underweight now. On Tata Chemical, the key reason for the big double upgrade to overweight is largely on back of sustained tightness in the soda ash market, as well as the fact that the company is doing better cost controls across the board. So the numbers are going to be quite strong for Tata Chemicals going forward, and hence a double upgrade on Tata Chemicals. Coming to the overall industry, Morgan Stanley is seeing a $25 billion opportunity till 2025 for the specialty chemical companies. One, they're going to benefit from the China factor, the shift from China, and two, the second leg of rally will come from upside will come from the Europe One strategy. So a lot of the European companies are going to face trouble, which means the production will shift to India, and that's where the big benefit will come for this Indian companies. So on back of that, between FY22 and FY25, Morgan Stanley is expecting a 22% profit CAGR for these companies, even though there's going to be some moderation in demand and there will be some product margin pressures as well. So two big calls from Morgan Stanley today: a double downgrade in Tata Chemical, and double upgrade on Tata Chemical, and a double downgrade on Aarti Industries.
Okay, all right, Nimesh. Thanks very much for that. So a lot taking place within the entire chemical space. But let's move on. Godrej Consumers ended the day 3% in the green. This is after it looks to expand its Africa portfolio. Manglam is here with the details.
Well, Godrej Consumer did well in today's trading session, and that's primarily on account of the conference call that it held with investors yesterday, specifically on their Africa business. Remember, their Africa business has been growing in double digits for the last 8 quarters, and now the management believes that the next leg of growth will come in from them actually widening their portfolio and adding more portfolio products to the pipeline, the distribution pipeline that they've expanded in Africa itself. Importantly, they believe that margins could be anywhere between 15 to 17% in their Africa business, and the analysts like that. So we had brokerage comments coming in from Jefferies, Credit Suisse, Morgan Stanley, all of them actually having favorable ratings on the stock with target prices ranging between 975 to around that 1100 rupee mark as well. But not just Africa, if you take a look at the India business as well, the second half of this year is extremely crucial for the entire consumption space, and Godrej Consumer in particular, because one, their key raw material for the soaps business, which is palm oil, has been at a 52-week low, so that could mean margins would expand in the second half. And secondly, 60% of India's consumption, a little more than that, happens in the second half of this year post monsoon, so that should augur well for the top line for the company as well. The only two problems that the company needs to resolve is one, the weakness that we're seeing in their Indonesian portfolio, and the second one is the weakness that we're seeing in the household insecticides category for Godrej Consumer. These two verticals have been weak for the last few quarters, so any improvement on that front is something that the street would like as well. It's perhaps because of this weakness that the stock trades at a discount to the sector at around 37 times 1 year forward earnings, but if these are fixed, then maybe the valuation support would take the stock even higher from here.
Okay, all right, Manglam. Thanks very much for that. On that note, it's a wrap on this edition of Markets Today. Thanks very much for watching.